Welcome back, everyone. Currently on my channel this year, I'm doing a brokerage account challenge, and in the comments section, people keep saying, Jake, why not just buy Tesla? It's a guaranteed money maker. All right, fine. So in this video, we're going to talk about Tesla, but before you thumbs down the video, hear me out. Hear out what I have to say, because if you like Tesla, now might actually be a good time to buy more. So the question that I'm asking is Tesla a Ponzi scheme? And upfront, of course, no, the company itself is not a Ponzi scheme. They've got solar panels, they've got batteries, they've got self-driving software and tech, they've got cool cars. I myself would like to buy a Tesla in the near future. So the company itself is great. Elon Musk has developed this cult of personality around him. I do love how science-orientated he is, and I like his frankness and open conversations. However, I think the tweeting gets him in trouble, and he probably is doing these tweets just to mess with the stock price, and he shouldn't be doing that. But it is what it is. Elon is who he is. He's now the richest man in the world thanks to Tesla stock price. Now, is Tesla stock itself a Ponzi scheme? And that's what I'm going to argue in this video. The company itself is doing fine. It's doing its thing. Tesla, the company, is not in trouble. But Tesla's stock price right now is being treated like a Ponzi scheme by investors. So what drives the share price of a company up? More buyers than sellers. As long as there are more buyers than sellers, then Tesla's share price will continue going up. Now, what's a Ponzi scheme? Well, a Ponzi scheme is where the original investors can only make money by more investors coming along that pay a greater amount. Now, in a true Ponzi scheme, there is no product or good being provided, and the original investors are being paid with further investors' money. I realize that isn't exactly what's happening here. Stocks are different. Either it's all a Ponzi scheme or none of it's a Ponzi scheme. But let's talk about this. Let's talk about stocks and their value. Now, if you buy real estate, you have a physical asset. You have a physical building that is yours. And when you buy bonds, you're given a guarantee. There are legal protections that the bond issuers, state or local governments or corporations, they have to pay you back. They have to pay you back with money from the company. However, the value of a stock does not equal the value of a company. In theory, it should. You're being told that when you buy stock, you're buying a share of the equity of a company. But this isn't correlated. It doesn't have to correlate. People can pay whatever they want for one share of stock. So the value of the stock does not have to equal the value of the company, even though it should. And once a company has its IPO and it's publicly traded, it's 100% the buyers and sellers setting the price of the stock. All the profits that a company generates stay 100% in the company. They keep it for themselves. If you make money in stocks, past this point, you have to be making money from other people buying your share from you. Now, of course, companies can do certain things to reward their shareholders. They can pay dividends, which do come from profits from the company. They can also allow voting rights if you own a certain number of shares on their board. They also can do stock buybacks, which in theory should drive up the value of your existing shares. However, that's not happening with Tesla. That's not happening with a lot of high growth companies. They're not paying dividends. They don't give voting rights. For example, Google stock doesn't do that. And with Tesla, it's actually the opposite. Not only are they not doing stock buybacks, they're actually issuing more stock. And issuing new stock dilutes the value of the current stock shares that you have. So Tesla has been issuing a lot of new stock recently, and it hasn't stopped the price from going up. Next thing you need to know is that your current asset value is not equal to your cash out value. I think when people look at this valuation, what is the valuation currently? It's $768,930,000,000. And that is what all of the shares in everybody's brokerage accounts collectively is worth. But that's not what people are going to be paid. That is physically impossible. People like looking at the account balance of their Tesla stock and how it's gone up so much. And people think that's money in the bank. They think that's money there. This $768 billion doesn't exist anywhere. The only way that people can get this money is if they do a market order or a limit order, they try to sell it, and somebody is willing to give them that money. If everybody currently holding Tesla stock wanted to cash out, then an equal number of people with $768 billion need to buy in. And I think ordinary investors just don't comprehend this market cap valuation. So Apple is the largest publicly traded company in America. Microsoft is number 2. Amazon is number 3. Tesla is now number 4 with a market cap of $768 billion. To put this in perspective, Tesla is now valued above Facebook. It's valued above Alibaba, Google, JP Morgan Chase, Walmart, Procter & Gamble, Nvidia. This is crazy. And when comparing companies, you're supposed to compare them with other companies in their industry. When you look at the market cap for Toyota, $246 billion, GM, $68 billion, Honda Motors, $50 billion, Ford, $38 billion, Tesla is now valued more than every other automotive maker in the world. So this is the equivalent of saying Tesla now has a global monopoly on the manufacturing and sale of cars. It's more valuable than everything else existing today. Now I hear the arguments, but Jake, Tesla is a technology company. It's going to disrupt industries. It's going to change the world. Well, okay, if you want to toss in Intel and Adobe, it's still bigger than all of these combined. So let's think critically here. How did we get here? How did we get to a market cap valuation for Tesla being $768 billion? And this is kind of where the conspiracy is going to come in, because it's not the Robinhood investors. If you watch CNBC, they'll say, oh, those Robinhood investors, they don't understand valuation, they don't understand fundamentals, they're buying stock just because they like it, they're driving up the price, it's ridiculous. Robinhood investors do not have $768 billion. We did not get here from small dollar donors driving up the stock price. So what's happened here? To reach this valuation of $768 billion, the big banks did this. The active fund managers at State Street and JP Morgan Chase, Goldman Sachs, Morgan Stanley, Charles Schwab even, at some point, the active fund managers knew what was happening with Tesla stock, and they decided to drive it up themselves. They're the ones with tens or hundreds of billions of dollars at their disposal. They're the ones who caused Tesla's stock price to go up so high. But why would they do this? Why would the hedge funds and the active trader funds drive up the price of Tesla stock so much? This is where the Ponzi scheme comes in, because once again, when there's more buyers than sellers, drives up the price. And we'll demonstrate this with a graph. I can explain this simply. So here we have price over time of Tesla stock. Now, originally, who were the A buyers? Who was in Tesla stock, 3 or 4 years ago? This was long-term buy and hold investors. This was people inside the company. This is people looking at the fundamentals and saying, wow, okay, this is what the company is worth. We then had a buying spree amongst the B buyers. Who are the B buyers? This is the Elon Musk fanboys. This is the people who love Tesla and they believe in Tesla. Yes, the fundamentals weren't there. Yes, it still has a ways to go, but you want to own it now because you love this company. So the B buyers drove up the price to a certain point, a point where it was close to being added to the S&P 500. And this causes kind of a snowball effect. And this is where the C buyers come in. The C buyers are the big investment banks, the hedge fund, the active fund managers. And they're the ones who drove up Tesla price to ridiculous, unattainable market cap valuations. And they did this because they knew there was one more group of investors who are going to come along. And these are the D buyers. We're going to talk about the D buyers in a second. But when the D buyers finish buying, the C buyers are waiting for this event. They know when it's going to happen, and that's when the sell-off is going to occur. So if you are a C buyer, your cost basis is somewhere around here. As long as you sell up here when the panic and the downfall occurs, you're going to make money. And once there's a panic sell on Tesla stock, this is going to spook the B buyers, the people that say, wait, I only bought Tesla because it goes up. Why is it going down? And we're going to trigger people's stop losses, and there's going to be a massive sell-off of the B buyers. After that will be the A buyers. These are the people who bought in years ago based on the book value and the fundamentals, and they're watching this meteoric rise and then this fast fall, and once again, you're going to start triggering stop losses, and people just want to sell out while they still can make a profit. You know, a 200% profit in 2 years is pretty good. So even if you're selling down here, as long as you bought over here, you're looking good. So who's left taking the massive losses? It's the D buyers. Now, who are the D buyers? The D buyers are the index funds. Wall Street braces for trading surge as Tesla joins the S&P 500. And this was reported in the news. I was following it, but I didn't do the math. I didn't run the numbers of how crazy this event was going to be. So this was predictable. All of these large investment banks knew this was coming, that Tesla's price per the market cap value shot up so much that once the index funds were going to add it, it was going to make it shoot up even more. And what's funny is all these banks have passively managed, well, not all of them, but most of them have passively managed index funds as well. So the people on the active investing side knew what their passive investing side was about to do, massive purchasing of Tesla shares. So they rushed into the stock to drive it up. So the index funds then have to buy it at a higher price. And index funds cannot detect a Ponzi scheme. That is the beauty of index funds. They don't make emotional decisions. They also don't make intelligent or rational decisions. An index fund has to buy shares based on the proportional size of that company. This wheel is outdated because Tesla should be right here, number 4. So let's just think about this. VT Sachs, I believe, is the largest mutual fund by assets under management. So fund total net assets, $1 trillion. So if the total stock market is about $40 trillion, VT Sachs, this one fund, owns 2.5% of the entire New York Stock Exchange. It's pretty crazy. And Vanguard has dozens of mutual index funds, passively managed funds, along with BlackRock, Fidelity, Schwab, all these other banks. And when you look at their top 10 largest holdings, they've been adding Tesla. This is a total stock market fund, so they've been buying Tesla steadily for a while now. But it's currently at 7, and it has to be here above Facebook and Google at number 4. So if Tesla's current market cap valuation is $768 billion, and the total stock market is like $40 trillion, 2% of VT Sachs has to be Tesla now. The index has to keep buying. So this one fund by Vanguard has to buy $20 billion worth of Tesla shares, and it's been doing that. It's been doing that continuously. The big change is for the indexes that track the S&P 500. So this is Vivafax. The ETF equivalent is VOO. Total fund net assets, $620 billion. So if the total S&P 500 is 32 trillion, Vivafax, this one Vanguard mutual fund, owns 1.6% of the entire S&P 500. That's a crazy large number. And when you look at their top 10 largest holdings, Tesla's not on here. Tesla needs to be number 4 above Google and Facebook. So if Tesla's market cap is 768 and the S&P 500 is 32 trillion, 2.4% of this fund has to be Tesla. And this fund is doing this now. It can't do it all in one day, obviously, so it buys like a little bit of Tesla every day until it can rebalance and make Tesla the 4th largest holding in this fund. And 2.4% of $620 billion is $15 billion. This one index fund has to buy $15 billion worth of Tesla stock. So who are the D buyers? It's the index funds. The C buyers, the active fund managers who piled into Tesla last fall, knew that the D buyers were going to have to buy hundreds of billions of dollars worth of Tesla. And, you know, what's going to happen here? At some point, the indexes will finish buying. They haven't finished buying yet. Tesla's going to keep going up in the next couple months. And once the active fund managers know, I mean, they have access to their accounts. They know how many shares of Tesla are in Vivafax and VT Sachs. So once the indexes are done buying, we're going to start seeing this sell-off event. Once the fuel has run out The C buyers are going to, I don't know, maybe have a group chat or get together for lunch and say, okay, today is the day we sell for a massive profit. Congratulations, everyone, we're geniuses. Now, for those of you holding Tesla stock, I'm sure you're saying, Jake, you got to be more specific than that. I need to know exactly when this is going to happen. Well, I'm going to say you got a couple months. The reason why is because of taxes. I think a lot of decisions made by these large investment funds revolve around buying and selling to pay the least amount of taxes possible. That's pretty smart. And if you hold stock longer than a year, then you're guaranteed favorable long-term capital gains, either 15 or 20% on the profit you made from the sale. However, if you buy and sell in less than a year, then you're going to have to pay a much higher federal tax rate on your capital gains. So when was the last local low in the last year for Tesla stock? It was during the pandemic, this once-in-a-century event. And Tesla stock bottomed out on March 18th when the share price hit $72.24, and it has gone up to a high of 880 since then. So let's pretend that you bought 500 shares of Tesla at $72. Your cost basis was $36,120. If you sold it today or at the high on January 8th, you would have had $440,000. So a capital gains profit of $403,890. So what kind of taxes do you pay on this if you're paying long term? Well, you'd be paying $60,584. But if you sold it before March 18th, then you're going to have to pay more than twice as much, $141,000. So this March 18th date for a lot of stocks that bottomed out during the pandemic, I think this is going to be a sell-off point. I also think that there's another psychological barrier that small dollar investors are waiting for. I think people want to see the market cap hit $1 trillion. This is going to be a newsworthy event. I also think people want to see the share price go to $1,000. There's a lot of people who own Tesla stock that I think say, well, I'd like to take some profits, but we're almost at $1,000. Why don't I just wait until it hits 4 digits and then sell out then? So once again, I can see Tesla stock going up to that nice round number of $1,000 per share. It's probably going to hit that in the next week or two. And these active fund managers who have been buying Tesla, they know what's happening. I know in this video I'm kind of promoting a conspiracy, but knowing what's going to happen and then using that information to make a profit for yourself or your customers, that's what you got to do. And this buying spree, this buying frenzy will start to gas out once we hit March 18th. Once individual investors can start selling off for long-term favorable capital gains. In addition, these fund managers know when the indexes are done buying. They're going to have to rebalance until they have the appropriate percentages of Tesla stock. And once they're done buying, Tesla stock's just going to slowly deflate. In addition, I think people are also waiting for a bailout point. Everybody here probably is setting stop losses to automatically trigger should that event occur unexpectedly. So who's left holding Tesla shares at a loss when all this is done? It's the passive investors. It's the index fund investors. They're the ones left holding the bag. And once this sell-off event occurs, the index funds will just make it worse. Once Tesla's market cap value goes down to 300 billion, 200 billion, 100 billion, whatever, the index funds will have to rebalance once again, selling everything they bought up here for a loss to make it proportional once again to their market cap for the S&P. So that's what I wanted to explain for you guys in this video, that Tesla stock is potentially a financial Chernobyl. It's going to deflate. It's going to pop at some point. However, this has nothing to do with Tesla as the company. The company is doing fine. The company is going to do great. They're issuing new stock. They're making billions off of people over purchasing their stock today. So Tesla is set. It's good to go. I think 10 years from now, Tesla as the company will be doing great, but how long will it take them to recover to their current stock valuation? It's going to be a while. Okay guys, if you enjoyed this video, give me a thumbs up so the algorithm knows it's good. In addition, consider subscribing to my channel. I talk a lot about finance and investing topics. And if you have any questions or comments, don't hate me. this is just what I think will happen. This is an opinion channel. Till the next video, take care.